However, it is important to note that the burden of taxation does not fall equally on all citizens. According to a report by Oxfam India, in the financial year 2019-20, the top 1% of India's population held more than 4 times the wealth held by 70% of the population. Moreover, the report also suggests that the tax system in India is regressive, with the burden of taxation falling disproportionately on the poor and the middle class. This is primarily due to indirect taxes, such as GST, which are levied on all consumers, regardless of their income levels. In recent times, there have been calls for a more progressive tax system in India, where the burden of taxation is more evenly distributed among all citizens. Some experts have suggested increasing the tax rates for the wealthy and reducing the tax burden on the poor and the middle class. Taxation is an essential source of revenue for the Government of India. According to the Budget 2021-22, the total estimated tax revenue for the financial year 2021-22 is approximately 22.17 lakh rupees crore. The major sources of tax revenue for the Indian government are GST, income tax, and corporate tax. In the financial year 2020-21, the government collected approximately 9.45 lakh rupees crore from indirect taxes, which include GST and customs duty. India has a relatively low tax to GDP ratio compared to other developing countries. According to the World Bank, the tax to GDP ratio in India was around 17.7% in 2019, which is lower than the average tax to GDP ratio of 20.9% for developing countries. Moreover, the tax system in India is also quite complex, which makes compliance challenging for taxpayers. According to the World Bank's Ease of Doing Business Report 2020, India ranks 115th out of 190 countries in the paying taxes category. Income tax in India is levied on a slab system, where individuals are taxed at different rates depending on their income levels. For the financial year 2023-24, the income tax rates are as follows. For individuals with income up to 2.5 lakh rupees, no tax is applicable. For individuals with income between 2.5 lakh rupees to 5 lakhs, the tax rate is 5%. For individuals with income between 5 lakh rupees to 10 lakhs, the tax rate is 20%. For individuals with income above 10 rupees lakhs, the tax rate is 30%. It is important to note that the income tax rates and slabs are subject to change each year, depending on the union budget presented by the finance minister. Apart from income tax, individuals and companies are also required to pay other taxes, such as corporate tax, capital gains tax, and dividend distribution tax. Corporate tax is a tax imposed on the profits earned by companies and corporations in India. The corporate tax rate in India for domestic companies is 22%, and for foreign companies, it is 40%. However, the government has introduced certain tax incentives to promote investment and entrepreneurship in the country. For example, startups and small businesses with a turnover of up to 50 crore rupees are eligible for a lower tax rate of 25%. Moreover, the government has also introduced a tax holiday scheme for certain sectors, such as infrastructure and power. Under this scheme, new companies that start operations in these sectors are eligible for a tax holiday for a certain period. The government has also introduced various measures to simplify the corporate tax system in India. For example, the government has reduced the number of forms required to be filled by companies for tax compliance. The government has also introduced a system of electronic filing of tax returns, which has made the process of filing tax returns more convenient for companies. However, the corporate tax system in India still faces certain challenges. For example, the effective tax rate for companies in India is much higher than the nominal tax rate due to various surcharges and cesses. This makes India's corporate tax rate one of the highest in the world. GST, Goods and Services Tax, is a comprehensive tax levied on the supply of goods and services in India. GST is a destination-based tax, which means that the tax is levied at the place where the goods or services are consumed. The GST system has 3 components: Central GST, CGST, State GST, SGST, and Integrated GST, IGST. The CGST and SGST are levied by the central and state governments, respectively, on intrastate supplies of goods and services. The IGST is levied by the central government on interstate supplies of goods and services. GST has simplified the tax system in India, making it easier for businesses to comply with the tax laws. It has also helped to reduce the cascading effect of taxes, which was a major issue under the previous tax regime. Under GST, businesses with an annual turnover of up to 20 rupees lakhs are exempt from registering for GST. Businesses with an annual turnover between 20 lakh rupees and 1.5 crore rupees can opt for the composition scheme, which allows them to pay a lower tax rate but does not allow them to claim input tax credit. However, GST has also faced certain challenges, such as the complex filing and compliance procedures, and the high rates of tax on certain goods and services. Thank you for watching our video on taxation in India. We hope that you found this video informative and helpful. If you have any questions or comments about taxation in India, please feel free to leave them in the comments section below. Our team will be happy to answer them. Also, don't forget to like this video and subscribe to our channel for more informative content like this. We post new videos every day, covering various topics related to business, finance, and economics. Once again, thank you for watching, and we look forward to seeing you in our next video.